it's looking slightly hard to predict the feel of the world, and the breadth also is just in sync with what is happening to global equity markets. 496 advances, 951 declines. So it's turning out to be a bad day and a poor day of trade, irrespective of the cut you look at. Small cap, mid cap, large cap, irrespective of the cut you look at, it's turning out to be a rather feeble start with a downward bias. Now let's address the newsmakers. LT Mindtree, Wipro, Bajaj Auto, and then IndusInd Bank. All four numbers, Nifty 50 numbers, came out with numbers in the second half. And Bajaj Auto has hit out of the park, 122 rupees higher for Bajaj Auto. IndusInd Bank, the numbers are not bad at all, and there is an MSCI inclusion which would be at play, which is helping the stock today, 26 rupees higher for IndusInd Bank. And then let's top it up with what you've got in terms of, the fourth one was LT Mindtree. So let's top it up with LT Mindtree also. What do we have in terms of a market reaction? And the market reaction, this one is going against the grain. But is it a good idea to buy a stock when the sector per se is not in a great shape? So that's the market breadth for you. Little bit of reaction to earnings. That's about it. Nothing major, nothing large, nothing alarming, but nothing exciting.
That's really the picture coming in across the board. Couple of other names which are going to be in focus. We've already flagged off what IndusInd, Bajaj Auto are up to, or for that matter, even LTI and Mindtree. Persistent as well came out with their numbers. The constant currency revenue growth is above estimates. The deal wins are at a record high. So look out for Persistent as well. That's definitely moved up smartly, 2% higher on that stock. There's Coforge as well, which has maintained its FY24 constant currency revenue growth guidance. The dollar revenue is above estimates. So some of these outliers from within the mid-cap IT arena. ICICI Lombard as well, wherein the gross direct premium incomes have come in higher by about 17.5% nearly. Profit is up 2.2% on a year-on-year basis. That stock as well has moved up 3% as we speak right now. In the meantime, Bandhan Bank's numbers were below estimates. The asset quality as well has seen a deterioration. So look out for what that stock is doing. 3.5% of a gap down for that one. And then, of course, there's a Shoppers Stop. There's Dabur as well, wherein the litigations against three of its subsidiaries in the US and Canada have actually come out. There's Wipro, of course, which has been a dampener too. So all these are earnings reactions coming in. Before we take it across to Nilesh Shah from Envision Capital, I quickly want to take it across to Kunal and Naresh and get in some first trades going as well. Kunal, firstly, a word on the index.
Well, doesn't come as a surprise that we've opened down 0.5% to 1% approximately for the indices. Would expect the index to remain under pressure at least for the first half after trading today. But in terms of outperforming sectors, Maruti is something which I would pick up in terms of the opening trade. Auto stocks still look very strong, and many of the auto stocks have confirmed a breakout for themselves. So Maruti is one of the names which I'll be bullish on.
Naresh, what are the first trades or trades that you're punching in?
So being defensive like Sun Pharma, this could be a stock which could play defensive as well as breakout in the short term. So expecting that to take a move towards 1200, 1250.
Nilesh Shah, Managing Director and CEO of Envision Capital, joins us. Let's take our conversation forward and understand where he's, in a sense, picking up the spots right now. Nilesh, this is not your office, right?
No, this is from home.
You were supposed to come to our office. What happened?
I guess there's no space in your office, so I thought I'll do it from my office.
अरे भैया आपके लिए तो हमेशा जगह है आप आइए next time.
Thank you so much, Nikunj. That's very kind of you.
Nilesh, it's not alarming, but it's getting sticky. Markets are hitting a pause button. Do you think we've done for the year in terms of a level, in terms of where market would settle at?
I would tend to think so, Nikunj, that we've had a sharp kind of an up move over the last 6 to 9 months. And so this calendar year, this financial year so far has been fantastic in terms of price moves, in terms of re-ratings, and then that's got backed by strong earnings growth as well. So on the whole, it's been a good time so far. In this year, probably for the first time, we are seeing some bit of chinks in the armor in terms of how the geopolitical equation now kind of changes or impacts macroeconomic stability, how crude oil behaves, impact on inflation, interest rates. These are the kind of challenges which could come to the fore, which can create some kind of pause buttons. But I think barring issues around sentiment, I don't think that we have any other kind of risks that we need to worry too much about. I think, yes, there's been a lot of talk about this whole geopolitical stuff. But if that were to have had an impact, I think it would have had an impact. It doesn't take kind of, 1 week or 2 weeks for these kind of impacts. We've seen, in 2022, the whole Russia-Ukraine stuff. And earlier on, there have been many, many geopolitical challenges the world has faced. That time, the market's reaction used to be very quick, very swift and impactful. That's not the case so far. So maybe right now, yes, there are initial signs of worry, but I don't think it's something that I would be too worried about on a very extended basis.
So what, to your mind, could be the biggest moving part? Could it be interest rates? Could it be the dollar index? Or could it be crude once again?
I believe that of the three that you mentioned, clearly crude is the one which, has multiple kind of impact. Crude obviously has impact from fuel prices, consumer inflation, interest rates, trade deficit, balance of payment issues, and then the currency impact. And that's also which basically also prevents a lot of fence sitters from basically putting money to work, especially international investors, because that's one of the key monitorables that they have always tracked for India over not just the last few years, but over decades. So that's been an age-old kind of a variable, which does move the needle, which does impact sentiment. So I probably think right now it is going to be crude oil. And as long as we remain sub 100, I still think that's the kind of comfort zone. The moment we cross 100, it will start to tell in terms of sentiment, in terms of incremental flows, and eventually on margins of companies.
Why are private banks trading cheap? HDFC Bank, it's trading at valuations which are lower than what they were pre-COVID and pre-IL&FS, ditto for Kotak. And I can also say for Bajaj Finance, even though it's an NBFC. The growth is there. You have what we say sometimes a 6x6 visibility for next 2 or 3 quarters for these for this sector and for these names. Yet markets are giving them a stepmotherly treatment.
I probably think it's more got to do with the growth differential. The banking sector, the lending space, credit plays, they're all kind of growing and growing really well. The challenge is that the big banks probably are growing at about 15-18% versus that the smaller banks, the specialized credit plays, some of the NBFCs, smaller NBFCs are growing at least at around 25%. And in the process, they're continuing to hold on to asset quality. There's been improvement in asset quality, and there's been some expansion of return on equity as well. So market definitely gravitates wherever there is superior growth. And we've seen this not just for banking, we are seeing this for a whole bunch of sectors, including, say, for example, the IT sector, where the large companies are not able to grow or are growing in low single digits, versus that the mid caps, the small cap companies are growing at a much faster pace, or the tier 2, tier 3 companies are growing at a much faster pace. So I clearly believe this is a phenomena which we are seeing across sectors. It's obviously become more stark in the banking space versus other sectors, but I clearly believe it's more to do with growth differential. And as long as we continue to see growth differential coming in from tier 2, tier 3 companies or smaller companies or mid-sized companies versus their large cap peers, I clearly believe that will continue to get reflected in the stock price outperformance as well.
Nilesh, what is the best way to approach this market? Raise cash because downside and better entry levels are coming, or stay invested but just prepare for a volatility? It will be volatility. There could be volatility, but no risk per se.
Nikhil, I don't think taking cash calls is going to help meaningfully or is going to help significantly. It may just be a more transient strategy, but clearly the bottom line is that the Indian economy is essentially going to continue to be a star. It's going to continue to be an outlier in the global context. Several businesses, several individual companies are performing extremely well. They continue to grow at a healthy pace. They remain capital efficient. And so clearly the long-term bull market is intact. Now within that, trying to kind of, tweak here and there with 5, 10, 15, 20% allocation may not really help. So I would probably still say stay the course, stay invested. just that remain bottom up focused. Don't just basically buy a stock because it is large cap or because it is small cap. I just think look at every individual idea more from a bottom up perspective, from a micro perspective. And if it's growing at a healthy pace, the balance sheet is intact, governance is intact, and if capital efficiency continues to be robust, I think you should be there. And as long as valuations you believe are reasonable, the price you're paying is reasonable from a medium term kind of a perspective, then I clearly believe that's the kind of strategy to follow.
So do you have less cash and more ideas, or it's the other way around for the first time?
No, I clearly believe right now, though, we continue to have a whole bunch of ideas. So honestly, we are fortunate that in India we have a universe which runs into thousands of companies. There are 3,000 plus companies listed, and of which at any point of time you always have a universe of 300, 400 companies which you believe meet at least the basic criteria. And from there, you've got to pick maybe your 20, 30, 40 stocks and construct a portfolio. So clearly believe that right now, the ideas factory, if I may use that word, the ideas engine, the ideas factory continues to essentially be very strong, very robust.
Okay, Nilesh, share some data. I'm sure you've got this data. I'm just bringing it for the conversation here. If one looks at the historical average for large cap, mid cap and small cap, excepting large cap, the mid and the small cap indices are trading above the historical average. The mid cap index is now trading at Nifty mid cap index is trading at 25 times, and the Nifty small cap index is trading at 18 times, 19 times, which is above the 5-year average. So why should one buy mid and small cap stocks when these indices per se, which is a reflection of the broader market health, they are trading at a premium to the historical averages?
Maybe Nikunj, along with this data point in terms of valuations, it might just be useful also to have data in terms of the growth differential. And currently, the mid-sized companies or the small-sized companies across sectors are having superior growth, and there is significant growth differential between large caps and mid to small caps. And that I clearly believe is essentially the moot point, number one. Number two, the balance sheets of mid and small size companies, the balance sheets of large cap companies were generally always very good. Clearly, mid and small sized companies, their balance sheets have improved quite dramatically, and they have deleveraged. In addition to that, there are a couple of other factors which I think are extremely important, extremely pertinent. One is the access to capital at an affordable cost of capital. I think for mid and small size companies has improved and improved quite significantly. Even over the last 4 to 8 quarters, when we have seen higher interest rates, it's not that the mid and small cap companies have to pay a lot more versus the larger companies, in the sense that they're not starved of capital. They still have capital and they're able to borrow at a reasonable price to fund their growth plans. I think clearly that is number one. Number two is with the help of technology, online, e-commerce, the access to markets has also improved quite meaningfully for mid to small cap companies. So I clearly believe that access to capital and access to markets has improved quite meaningfully for mid to small cap companies. And I think in a whole bunch of companies, the quality of governance, the quality of investor communication has also improved quite significantly. So I think there's a huge amount of improvement which mid to small cap companies have seen in terms of growth differential, in terms of respect for balance sheet, respect for governance, access to capital and access to markets. I clearly believe that these are the 5 factors which are making a huge difference. And I don't believe that these factors are transient. These are factors which are very enduring, are very structural, and will continue to play out for an extended period of time and will continue to play out for a multi-year horizon. So that to me is the big difference that we are seeing this time around. So just looking at premium valuations or valuations trading above long-term averages may not be looking at the entire picture in totality. It may just be looking at probably part of the picture.
You've given us the template. Why you should not be looking at just this P multiple and then taking a call. And I think that is such a great point. I mean, we can look at one data point and say, okay, this is what has happened in the past, so future it may happen, but conditions are different, environment is different, interest rates are different, and the investing environment is also very different. So our viewers, they need to understand here is that big money is always made when you buy good businesses and ride them for years. And that's the time you will change from stock market from just an income generator to a wealth creator. The stock market will only create wealth when you're spending time. When you buy a house, you buy it for 10, 15, 20 years. It's passed on to generations. That's the same thing, I guess, what Nilesh is also talking about. You should do in terms of the holding period. So Nilesh, अब तो भैया बात करते हैं template की. Now let's talk about the colors. Put that template which you made, the 5-point template, into individual names. Where have you been shopping and where are you picking some spots?
So Nikunj, of course, we continue to hold a relatively a focused portfolio, but it's a portfolio across sectors, and we have been liking names around capital goods, around defense, around auto components, the tier 2 banks, very specialized players in the financial space, which is online broking, online insurance. These are the kind of businesses that we have been owning. Also, our exposure to alcoholic beverages, we think that's a standout sector from a 5 to 10 year perspective. So that's the space that we have been kind of very, very positive about. Most recently, though, a lot of our new investments have been into more the technology space. I have earlier talked about the exposure that we have had to MapMy India, which is C Info Systems. NewGen is a company that we have liked and we've owned. They came out with some stellar numbers. One of our most recent additions has been a small IT services company called Datamatics. We clearly believe that in the case of Datamatics, they seem to be on a path of higher growth. They have reorganized their businesses, largely focused around digital and artificial intelligence, which I think will provide strong tailwinds for them to grow at an industry-beating pace. They probably still have some bit of margins to expand. They're trying to build an interesting products portfolio, which might kind of result into slightly non-linear growth going forward. And valuations are attractive. It probably trades in mid-teens in terms of trailing earnings basis. So I clearly believe that there are a whole bunch of sectors which we've continued to kind of be very positive about. But off late, it's just coincidental that some of our most recent investments continue to be around the technology space.
We had a conversation, Nilesh, which was centered around the fact that you need to buy specialized IT companies. I mean, you buy a SaaS company, you buy a company which essentially is giving more services rather than just IT services. So if that theme has to be applied, one is Datamatics, what else?
Datamatics is there. NewGen is there. I think that's again, they've announced their results very recently and they came out with some stellar numbers, business growing like kind of in the 20s, which I think is quite phenomenal. We continue to like LTTS, though they have cut the revenue guidance, but I still believe that in this current environment, if a company is talking of growing at 17-18%, which is high teens, and sustaining margins at 18% in terms of EBIT margins, and it's got a phenomenal size. I mean, it's now almost a 45,000 crore market cap company. So to that extent, it's not like kind of some small company out there. These are the kind of spaces. If I look at each of these companies, they represent very specialized space. I mean, L&T is basically an exposure to the ER&D space. They keep working on software-defined vehicles, the whole transportation, mobility space, semicon. That's the kind of space that they've focused quite a lot on. Datamatics is trying to basically improve the digital experience that businesses worldwide provide to their customers and to their own back office operations. So that I think is an interesting space. They're also kind of working on essentially providing ticketing solutions to the metro networks, both in India as well as to metro networks globally. I believe that's again a very, very interesting kind of an opportunity. NewGen is again a very specialized products company focused more on the BFSI space, largely focused on India and Asia, but now trying to kind of make a dent or a headway into the US and Europe markets, which creates solid tailwinds. They seem to have a lot of wind in the tail, wind on the back, which is helping them to grow. So these are some really nice kind of opportunities which are there. And on top of that, MapMy India, which is more a domestic business, but clearly like the business that they run in terms of digital mapping solutions, in terms of IoT-led navigation solutions, artificial intelligence, drones technology for the future. The number of use cases which they can have probably can be quite phenomenal. So it's an opportunity which I think is like kind of probably spans across the next 5-10 years. Obviously, each of these businesses runs risks of competition or disruption and volatility in the external environment. These are the kind of risks and challenges which most businesses do face. I don't think there are exceptions to that. But on the whole, on the balance, I think these are nice businesses to own from a medium to long-term perspective.
Between 1st of Jan and 18th of October, have your top 3 holdings or top 5 holdings changed?
Not very materially, Nikunj, not very materially. I still think we continue to own, the likes of Radico Khaitan, Angel One, PB Fintech, Mahindra Holidays. These have been some of our leading holdings. And Polycab. These are some of our holdings which we have continued to own. And we have not made any material change in any of these holdings.
Stocks like Polycab, Angel, they are up 70-80% from the recent lows. I mean, Polycab, the management was there in the morning, so we spoke to them. The stock is up 100%. What is forcing you not to book profits? I mean, these are good levels to book profit. Your investors would be happy. So what is giving you the conviction that there is some more juice left in the tank, or there's still more fuel left in the tank?
So Nikunj, over the years, one has learned that, downside protection or downside risks are also there, but you also have the risk of exiting a position too early just because it has done very well in recent times. My learning over several years in the markets is that as long as a business continues to perform well, it continues to deliver industry-beating growth, then you should essentially not be in any kind of hurry to exit, because it still can be a compounding opportunity, for a slightly extended period of time. We've seen over even the previous decade how a lot of growth companies got massively re-rated, and for periods like 10 years and all that, they give you annualized 40-50% kind of returns kind of opportunities. And anybody who took the risk of or took a call of exiting them too early missed out on a very extended period of gains. So I think it's the same kind of mindset. So I think as long as the business continues to do well, it's not that just that the company is good. What I mean is that the business continues to grow and grow in double digits. It continues to grow ahead of the industry. It continues to sustain its market shares, and it continues to identify adjacencies to growth and optionality. If these ingredients are still there, then I think it just probably still is prudent to continue to own these businesses. It doesn't mean that therefore that we may not exercise an option to exit any of these names which I mentioned. It's quite possible a few days later, or maybe a week or few weeks later, we may choose to exercise the option to exit. But I think currently we continue to essentially be reasonably satisfied with the way these companies are performing in terms of their businesses.
Okay, now liquor, or when it comes to buying the entire liquor space, some would say that, look, it's very simple. India will consume more, India will grow more, per capita will grow. Now that's a lovely macro thesis. But frankly, if I look at some of the liquor companies, they've had a lot of volatility in their numbers. They get impacted because of raw material. Growth is always in mid-teens. Even though we are looking at a complete change in terms of consumption pattern changes, market cap changes, and per capita changes, liquor companies are mediocre growth businesses. What gives you the conviction to buy a mediocre growth sector then?
So Nikunj, I think, and my view is slightly more long-term, that probably for the next 5 or 10 years, I see liquor companies being able to kind of grow at maybe 15 to 20% on an annualized basis. There could be a few years, few quarters maybe where the growth may be slightly lower than that, but I probably think on a very 5 or a 10-year perspective, they have enough tailwinds to grow at 15 to 20%. And then some of the liquor companies have faced margin pressures in the last 1.5 years because of rising prices of bottles and of glass and freight costs, transportation costs, rising prices of the core raw material and all of that. Some of them have also been expanding their capacities, have been building capacities, and therefore had to add capex and have taken some debt for that. But if you were to kind of look at, say, a next 5 to 10 years, say, for example, one of the homegrown liquor companies that we own, their margins have been around probably sub 10% in terms of the operating margins, EBITDA margins. I think over a 10-year period, can those margins go back to maybe 17, 18, 19%? I think so. So if you look at a 10-year perspective, revenues being able to grow 4x, even if the growth rate is 15%, and margins being able to double over a 10-year period. So if you have revenues growing 4x and margins growing 2x on a combined basis, the net earnings could potentially grow maybe even 8 times from here over the next 10 years. That's what I see in them. And it's hard to find businesses who can kind of, become 5 times larger or 8 times larger or 10 times larger over a 10-year period. I agree it's a slightly more long-term view, but that's also part of our thought process, and it's part of our investment strategy.
Nilesh, a lot of your peers would say we follow a simple policy, Sasta Sundar. It has to be a good looking business and it has to have a P multiple which is, 14, 15 times. The stocks which you've discussed, whether it is PB Fintech, Engine One, Radico Khaitan, Polycab, their P multiples are 40, 50 times. Now you're a value investor. How would you justify buying stocks which have P multiples which are 30, 40 times, even 50 times?
So Nikunj, maybe I probably just shared some. I mean, an Angel One probably is still trading at maybe 20 times, for example. So I think it's a whole range. I mean, we in our portfolio, we probably still have companies which trade at maybe even 15 times, and then there are companies which trade at even 40, 50 times. So it's a whole range, but I think on an aggregate basis, the composite P multiples of the entire portfolio is not at some massive premium to the market P, number one. And number two, Nikunj, in the market and in the world of investing, there are many roads to heaven. You pick your path, you pick your road. You do what works for you. And I think over a period of time, clearly buying growth-oriented businesses which are capital efficient and have a long runway of growth, I think it works as long as you are paying a reasonable price for it. I think our entry in a lot of these positions have been at valuations which were way more attractive. I remember, I think our first investment into Polycab was probably 3 years back towards the end of 2020, where we bought it probably at around sub 1,000 levels, 800, 900 rupees, when the valuations were in the teens for Polycab. After that, of course, Polycab continues to has gained massive, continues to do very well in terms of market share, has expanded margins, has grown in a very stellar pace, which has led to its re-rating. But our entry valuations were not very high. Now it can be very debatable whether at these prices are the valuations justifiable or not. But you always also need to take an overall portfolio approach, and you do what essentially works best for you.
Path to heaven could be several. That's a spiritual debate, Nilesh. But let me understand your path of becoming rich. What is that path which you are following?
No, I don't think you kind of have any path to richness or anything like that. You just keep doing what you like and what you keep enjoying. I think that's the bottom line.
The word rich, because that was an acronym I think we discussed several years ago. It was an acronym where you gave 4 stocks. So what's the new acronym now?
No, I don't think I have more names to share apart from what we have discussed, Nikunj. I think we've discussed a whole range of sectors, a whole range of companies, including our most recent investment. So I think, yeah, I mean, that's where it is.
No large caps, Nilesh. I mean, every fund manager is saying the margin of safety is bigger in large cap.
So yeah. So I think we actually now like the large private banks, Nikunj. We like HDFC Bank. Honestly, I still believe that over, say, a 3-year period, HDFC Bank will grow earnings at 15-20%. I think the valuations are at maybe 16-17 times on a trailing earnings basis, though banks you look at more on a price to book basis. But so if over 3 years a business is going to grow at 20% annualized, and if maybe the P multiples go towards 20 times, I think it will give you nice, compounding kind of opportunity. Our most recent investment has been Kotak Mahindra Bank. Both HDFC Bank, Kotak Bank probably have been flat over the last 3 years. I'm quite sure the next 3 years could be a lot more enriching for investors in both these two very outstanding, very respectable names. So these are some of the names that we like in the large cap space. We like ICICI Lombard Insurance when you ask about a large cap name. Clearly like it. I think the quarterly results yesterday were good, and probably they are again poised for some industry-beating growth from a 2 to 3 year perspective. So these are some of the large cap names that we like.
Nilesh, you've been very candid and very openly sharing your holdings and why you like them. So Just a disclosure on behalf of Nilesh Shah, whatever we've discussed, I think his portfolio has exposure to him. I'm sure his family and personally he may be owning some of the stocks. So what we've discussed on the show is a pure narrative to discuss ideas which he's liking on. But when you're investing in them, please do your homework. Nilesh, fantastic to have you on ET Now. Thank you for joining us.
Thank you, Nikunj. Always a pleasure.
Back with first trades and the market. Let's just revisit where the first rates have settled in at, because it's even worsened from that opening low. We're now down a good over 100 points for the index. We're just about, in fact, defending that 19,500 print. So let's see. Very swiftly, we've given up that 800 mark, and from there, it's only gotten worse amidst, of course, a weak handover from the global cues. Having said that, there are those outliers. Look at a Bajaj Auto. Even in this weak market, that stock is holding up nearly 4% on the futures. LTIM has been a big beat. That stock an outlier within the rest of the IT pack. That's holding up 3%. ICICI Lombard is a big mover. Good set of numbers. The market clearly is rewarding that. And then Persistent as well, with posted good numbers there. That also is holding up very, very smartly. Remember, the CC revenue growth was above estimate for Persistent. The real deal wins have come in at a record high. And that's something that the market is liking. There's a Havells as well, which is up about almost 1.6% as we speak right now. But let's take stock up and let's talk about what's happening within the, the business of healthcare. We have R. Venkatesh, the Group CEO at Narayana Healthcare, joining in on the show right now. Mr. Venkatesh, great to have you on the show. Help us understand what is the occupancy trend right now when it comes to your business.
So, I mean, quarter two always is a very good quarter in terms of occupancies. So, as per the industry standard, our occupancies have also been good. While every healthcare provider is working aggressively on occupancy, we still feel that is just not the only determining metrics to measure optimal utilization. We're investing in technology, process, capacity, bottlenecking that helps us turn around patients faster and improve our discharges efficiently, and eventually the throughput. So we work on improving discharge times before 2 p.m. so that there is no shortage of patients coming for admissions, improving throughput in ICUs, developing communication tools for the doctors and nurses to coordinate care faster, improving service delivery for better patient experiences, improving the turnaround time for our lab reports, diagnostic reports. There have been more than 40% improvement in the last 4 quarters. Appointment channels for all the patients through our own self-developed care apps, NH Care app and portal. More than 80% of all the appointments are done through that. The rapid process transformations, reducing the ALOS to less than 4 as per industry standard. And with the space we create through these savings, these measures, we try to focus on infrastructural enhancement to address these patient bottlenecks, which is OTs, ICUs, adding more OTs, more ICUs, diagnostics, lab billing, etc., which will enable us to increase the patient volumes at the same cost levels. So we are also working very well in terms of occupancy. Apart from this, we would say that the occupancy is also hovering somewhere around 65 to 68%, but that's not the only measuring metrics. I already mentioned very clearly the processes we are following in terms of improving the throughput, which is more important than just gauging occupancy alone per se.
Sure. But what about elective surgeries? Is there a delay in that, as was the case during COVID times?
There was a pent-up demand post-COVID in terms of elective surgeries, but there has been efficient throughput in terms of surgeries. And over the last 1.5 to 2 years, in fact, the year 23-24 has been the most stable and the consistent year in terms of a period post-COVID. Where there has been more predictability in terms of planning for surgeries, and things have been on course. There is no delay. Through our process efficiencies and efficient turnaround, we've been able to process all the patients waiting for surgery in a timely manner, and we would continue to do so in the coming days.
You have 70% of your business coming from owned hospitals. That means that your business is asset heavy. 30% is where you are getting managed services and other services. Could you be looking at reducing this number dramatically?
Over a period of time, we'll always have a combination of own models and asset-light models in terms of joint ventures with other partners. But the mix which we are following has been a very healthy mix, which has been time-tested, tried and tested, and the same mix will be eventually followed over a period of time. Of course, we would set up more of greenfield and brownfield initiatives in days to come. And the mix we would continue to make sure that is maintained in due course of time, or we are open to initiatives and partnership initiatives. But when it comes to the organization's plan and strategies, we would go more aggressive on greenfield and own models in due course of time. We have been very healthy in terms of our debt equity ratios in due course of time. We have done very well over the last 2 years. We have done aggressive expansions. We worked around more than 1,000 crores of investments over our greenfield initiatives last year. Even this year, we would be investing more than 1,000 crore in our greenfield initiatives, primarily on Cayman, Bangalore, and Calcutta. In spite of such investments, we would be staying healthy in terms of debt EBITDA and debt equity ratio.
Okay. So, I remember I've had the pleasure of tracking Narayana Healthcare, which has now become NH Healthcare, for years now. What our understanding of the model a couple of years ago was that it will become asset light. It will always be asset, it will not be investing a lot in terms of creating fresh capacities. But of late, you are looking at expanding. That's what my understanding is. You're looking at adding new capacities, and which are going to be more owned capacities. So is there a change in the strategy?
No, I see. You see, we continue to enhance our abilities to treat more patients, and bed addition is only one of the ways in which we do it. Bed addition is not alone a representation of the growth. We are investing in various capabilities. I've already said about how we improve our turnaround time, how we invest in technologies to improve on efficiencies. We will be able to sustain our organic growth momentum comfortably with this, and we'll also, till we get into our inorganic expansion. We're not saying that we won't purely only invest in capacity. We will also be investing in capabilities, which is like investing in equipments to improve the clinical capabilities, investment in our greenfield ventures, as I've said, to improve on capacity expansion. Whilst we look at a 30 to 40% expansion in our capacities in due course of time, we would put more emphasis on technology to improve our services and throughputs to patient for a better understanding. So while we say, when we look at expansion just doesn't purely mean capacity building. It also helps. It also is efficiency building to improve the deliverables in healthcare, which will make a very big difference in due course of time in terms of how the patients look at us.
All right, good to have you on board. Thank you so much for taking time out and joining in and giving us a perspective as to how business is trending. Quick break. Be right back with the management of ICICI Lombard. Thanks for staying on with us. Gopal Balachandran is the CFO and Chief Risk Officer at ICICI Lombard. Now joins in on the show to talk about numbers as well. Thanks so much for taking time out. Let's begin with trends in the motor segment this quarter. Would you say that the growth is back, or do you seem a little bit guarded?
So if you look at it, I think insofar as motor is concerned, for us, the trend line seems to be very, very encouraging. For example, in quarter one, our growth in motor was roughly at about 5%. In quarter two, that number has kind of inched up to almost close to about 10-11%. And relative to the market, I think we have been able to substantially narrow down the gap insofar as growth in that segment is concerned. The reason for us to be slightly still growing lower than the market is, if you look at the combined ratio, which is the results of what we underwrite, for the industry, motor combined ratio still continues to remain elevated upwards of 120% plus. So hence, to that extent, is where we are still kind of taking a guarded stance. Having said that, I think the trend line seems to be looking very, very encouraging. And more importantly, I think we will obviously also wait for the rest of the year in terms of how the expense of management play out for many players in the market. Because that's something, if you look at, for roughly half of the industry, participants are having their expense of management in excess of the regulatory thresholds. For ICICI Lombard, where we are well within the threshold, and hence to that extent, As and when that starts to see getting corrected, we would obviously be able to see incremental opportunities.
So you've increased pricing. Has the competition increased pricing, especially in the motor segment as well?
So I think again, if you look at it, motor as a segment for ICICI Lombard towards the beginning of the calendar year is when we had started to affect small amount of price increases. These are single digit price increases that we have seen. And as I said, many players in the market were very aggressive over the last 18 to 24 months. Many of them have started to calibrate their growth numbers. Given the higher levels of combined ratio that I spoke about, of roughly in excess of 120% for the market. And that's something that is not sustainable. So hence, many mid-sized, relatively large-sized, as well as small companies, they all have kind of started to calibrate growth, which is definitely very, very positive from an overall market development standpoint. At an industry level, I would not necessarily say that people have taken price changes, but we do see instances of companies calibrating growth either by increasing small amount of pricing or more importantly, as I said, also to kind of look at the overall expense of management.
So how do you see the loss ratio playing out, and how comfortable are you on the risk?
I think from an ICICI Lombard standpoint, one of the biggest strengths that we have is our ability to slice and dice portfolio in terms of various risk segments. And that's the basis on which we have always balanced growth with profitability. And hence, to that extent, even when you look at motor, of course, what we keep saying is to definitely refrain from looking at quarter to quarter numbers, because there could be a lot of elements that could go into quarterly outcomes. Rather, a better thing will be to look at more yearly numbers in terms of the way how the loss ratio trend lines could play out. Specifically in the context of the motor line of business, for let's say it has got two components, motor own damage and motor third party. On own damage, I think the loss ratio range that we are comfortable in terms of underwriting is between 65 to 70%. And similarly, third party, again, if you look at the full year numbers, that broadly has been operating at the range of 70% or thereabout. So again, that's a range that we would be comfortable in terms of underwriting and risk selecting portfolio segments. But having said that, we would again not look at just one of the components of underwriting, which is in terms of the loss experience. We would obviously want to look at it more in terms of the overall combined ratio for the segment and for the company as a whole, which is where we have again talked to the market to possibly get down to the objective of combined that we have laid out by end of next year, which is by end of FY25. We would want to see our combined ratio for the company as a whole going down to 102%.
Also wanted to understand about how the two-wheeler segment has been shaping up, because last time we spoke, you said that it was doing better directionally. Is it now looking substantially better?
So two-wheeler again for ICICI Lombard has been our inherent forte, and that's where roughly 1 in 4 two-wheeler insurances that happen in the market is predominantly insured by ICICI Lombard. And hence, to that extent, that segment is something, if you look at from an overall premium contribution, out of the overall motor line of business, two-wheeler for us contributes roughly about 27-28% of the overall mix. And that's broadly been the levels at which we have seen the mix of two-wheeler getting contributed. If you look at in terms of market demand, while on the private car side, the demand seems to have largely come back, two-wheeler, at least I'm sure when you also talk to the OEMs and in general when you're trying to find, and when we also do our own, let's say channel checks, clearly we see that still things are not necessarily out of the woods insofar as two-wheeler demand is concerned. Possibly it will take maybe another couple of quarters for things to come back. Having said that, as I said, for us, two-wheeler inherently has been our forte, and hence we continue to drive growth to that through that particular subsegment of the motor business.
Sure. Gopal, tell us what's happening with the health segment as well, because growth has been good this quarter. But going forward, what is the expectation from both individual as well as group segments?
If you look at in terms of what I had spoken even last quarter, for us, both corporate health and let's say individual or retail health, both of them are preferred segments of opportunities. And on both the segments, we have had industry beating numbers. For example, on retail or individual health, We grew by almost about close to 19-20%, whether you look at Q2 or half year numbers. The industry growth has been closer to about 18-19% or thereabout. So clearly we have been able to beat the industry numbers when it comes to individual or retail health. And that's an area, if you recollect, we have been talking about making continued investments in building our distribution force, which predominantly happens through the agency distribution. And that number, if you look at it for Q2, the retail health agency growth has been upwards of 21% or thereabout. So we are very, very excited with the way how the distribution investments are playing out on the retail health franchise expansion. And because of which we have been able to grow faster than the market. Our market share has slightly inched up. We used to be less than 3% market share in retail health indemnity. Now that market share is slightly upwards to 3.1% or thereabout. But having said that, I think, as I said, we have been able to grow faster than the market on the retail health front. On corporate health, I think the outcome is pretty much the same. Again, we have been able to kind of beat the industry insofar as the overall growth percentages are concerned. The good news is it has been across the board increase that one has seen. When I say across the board, it has been a growth that has been contributed by increase in volumes. It has been a growth contributed by increase in price. And equally, it has been a growth that it has been contributed by accretion of market share. So it's an all-round kind of an increase that one has seen on the corporate health side.
Now, your loss ratio on health continues to rise. Are there any concerns with respect to that? Where is it that you see your loss ratio for the overall health segment stabilizing?
So again, as we keep saying, again, when you start looking at numbers on a quarterly basis, obviously it could sometimes lead to a, let's say, misleading outcome. Primarily because what happens is in Q2 is largely periods of monsoon, when you generally get to see relatively higher incidences of health ailments. And hence, to that extent, you will possibly see, again, this is not just a Q2 phenomenon of this year. In general, when you look at Q2 of historical periods, you will always find the loss ratios to be slightly elevated than the rest of the quarters, which tends to get normalized as we head into the subsequent Q3 or Q4, which is why, again, when you look at it on a full year basis, as I said, insofar as the underwriting of this particular segment is concerned, I think we're very, very comfortable with the way we are doing our underwriting and risk selection. The good news is a majority of the portfolio on the corporate health side is relatively mid and small sized corporate health accounts, which ensures that we are able to get a reasonable price. And more importantly, we are also able to kind of retain the accounts for a very, very long period of times. And hence, to that extent, to answer your point, I think we are quite comfortable with the loss ratio range, which we have generally spoken to again to the market to be around that 94-95% levels, because here inherently the loss ratios will stay elevated, but the relative cost of acquiring this business is a low single digit number, which is why on balance, I think again from a combined ratio perspective, it fits within our objective, and hence we don't see any challenges insofar as writing this segment is concerned.
Okay, and you also have spoken about how your expenses of management are likely to change the game this year. And still, despite that, last quarter you suggested that 2/3 of insurers don't actually meet the EOM guidelines. So tell us a little bit more. What is actually happening at the ground level? What kind of traction is it that you expect the regulator to take, or what kind of action are you expecting in case of non-compliance of EOM?
So I think again, when you look at public numbers, so that 2/3 of the company was for the last financial year. Now we have the Q1 numbers for the players in the market. The trend seems to be kind of largely similar, which is more than half of the industry participants are operating at an expense of management threshold, which I said is well above the threshold of either 30 or 35%, as the case may be. I think insofar as the regulatory action is concerned, again, if you look at the EOM guidelines, the regulator had given them a glide path for companies which are above the threshold to meet the EOM guidelines within those stated glide path. But having said that, it's been just a couple of, we will have to wait and see how Q2 numbers play out for most players in the market. But the regulator will obviously wait and possibly see the trend line over the next 1 or 2 more quarters, and possibly see at the end of the year in terms of how many companies are still operating at thresholds which are over and above the laid down EOM threshold. And I'm sure given the thought process with which the regulator has come out with these guidelines, they would obviously start taking possibly severe steps against companies which are continuing to operate at levels which are higher than the laid down guidelines.
Now let's talk about the change of guard there. Bhargav Das Gupta, who has spearheaded the company for nearly 15 years, moves on. What changes?
From an ICICI Lombard standpoint, for us, management succession is something that we actively engage in. Not just now, not the fact that Bhargav's term was coming to an end, but even otherwise, at a management level, succession is something that the board and the NRC actively engages in. And hence, to that extent, whenever any of these situations entail, then to that extent, there is enough and more leadership depth that we have both within the company and within ICICI Group. And in this particular instance, I think the good part is, I think the NRC and the board found Sanjeev, who has been a part and parcel of ICICI Group and with ICICI Lombard since 2015, spearheading the retail division. He is the one who would now take charge as the MD and CEO. So hence, to that extent, I think it has been extremely smooth transition, and it indicates the leadership depth that the institution has created over a period of time. And hence, to that extent, the transition is very, very seamless. And insofar as the objective of the way how things will get played out, I think it will start. ICICI Lombard has always been kind of driving growth with profits. And even with this leadership change, the larger underwriting philosophy of the thought process in the way of the businesses will be underwritten will continue to remain the same. And hence, to answer your point, I think it has been a very, very seamless transition.
All right. Thanks, Gopal. Really appreciate your time. Meanwhile, what do we have on the markets? Well, we've got a Nifty which is inching higher. We've got a Bank Nifty which has inched higher. We are off from the day's low, and the market breadth is meaningfully better than what we started with. Rise with India. Very simple. We're doing much, much better than what the world is doing. And if one looks at the combination of risk on, risk off in the world, well, it's a risk on. We've not climbed back to what we lost in the opening first 10 minutes of trade, but directionally, the path of least resistance, I think, is on the upside. And can you imagine the small cap index is already in the green? Thank you. The small cap index is where the things are improving. Let's look at the market breadth if we can. The advanced decline ratio, just to establish that when we started in the morning, it was tilted. The beam balance was in the favor of declining shares, not in favor of advancing shares. It has not changed, but the gap now, that donut graph on your screen, the gap now seems to be narrowing down. Sudhir Singh, CEO of Coforge, joins us now. Sudhir, good morning. Thank you for joining us. Now, you've delivered a 16% growth in H1. Are you confident that you would be able to end the year of 13 to 16%, or are you on course to even beat that?
Well, we are absolutely confident. The guidance that we gave was at the beginning of the year, in a year where there's been significant macroeconomic volatility. At the beginning of the year, we gave a very assertive, a very aggressive guidance of 13 to 16% CC growth. At the midpoint of the year, as you noted, we are growing 16.2% in CC terms. I said this earlier in the investor call as well. The guidance that we gave at the beginning of the year is a guidance that we intend to deliver upon, and we believe that we will.
For the longest time I have tracked IT, this has been the template. Large companies, they were getting large orders. They were, in a sense, more bulletproof, and they were able to withstand the cyclicality in the IT sector. But in last 1 year, the headlines are large cap IT is slowing down, mid cap IT is growing, and they are growing at a rate which is higher than the industry average. Is this largely because of a paradigm shift in the business model for mid-cap IT and for companies like Coforge? What is happening? I mean, why is that good mid-cap IT companies are coming out with phenomenal numbers when the big boys are contracting?
Well, our growth template has not really dovetailed fully with the mid-tiers or the mid-caps as you talked about. We have grown consistently for the last 6.5 years. Our CAGR over the last 6 years has been close to 18%. So irrespective of whether the cycle has been in favor of the large caps or the mid caps, we have continued to do well. I can tell you why we are doing well. We are doing well because we've always maintained growth is not just a function of talking about large deals won. It is also a function of the delivery execution, the ability to also retain what was secured in earlier quarters. The reason why every quarter we call out an order executable number, the reason why every quarter we call out deals won, and then in subsequent quarters we show revenue growth and not flat or declining numbers is largely on the back of our ability both to continue to sign large deals as we have, but also to have an exceptionally high repeat client business. So that's been our template. The mid caps and the large cap story keeps oscillating every 2 or 3 years, but the Coforge story has stayed consistent for the last 6.5 years. We have delivered, come what may. We have delivered on our commitments, and in most cases have exceeded our commitments. This year is, we believe, going to be a repeat of that template, despite the very significant macroeconomic geopolitical uncertainties that came in, and despite the changes that have happened in other guidances. We have stayed firm from day one of the year, and will stay firm till day 365.
So let's focus a little bit more on how H2 is going to pan out. Will furloughs be higher than usual, you think, in Q3?
They will. We're already in Q3. Month one is about to get over. This year, the furloughs are going to be materially higher than they've been in the past. And that's largely a function of the macro stress that everyone's talked about and that we also experience on an ongoing basis.
You said that you expect a demand recovery from Q4 FY24 onwards. You think it could spill over to Q1 of FY25?
Well, our growth, if you were to look at it over the years, has not been a function of the demand environment. In a year like this, in the first 2 quarters of the year, which have really been extremely demand stressed, we have still delivered a 16.2% CC growth. As we look at the future, we are confident, irrespective of which way the penny falls around demand, whether demand revives in Q4 or not, the number that we've guided to, we will deliver on. When we look at the demand environment, we believe it is going to continue to stay stressed for the rest of the fiscal year. Having said that, it is also equally important to note that even in tough macroeconomic in a tough macroeconomic context like it is these days, there are always green shoots available and areas to expand on. In this quarter itself, out of the 3 large deals that we've signed, 1 large deal is in banking, which everyone recognizes as a stress sector. And that is a large deal, not with an existing client. It's a new client that we've signed with a large deal. That's a large statement of work with a new client itself. So summarizing the answer, we expect the full fiscal year to see a tough macro environment. We expect at the same time that we at Coforge will still deliver on the guidance that we've given. And we also believe that despite the tough times, and times will be tougher otherwise in the years to come, we will continue to deliver and execute as we have.
Would you tell us how large this large deal is? Would you?
All large deals, which we call out every year, we classify anything more than $20 million TCV, not extending beyond 5 years, as a large deal. This one was a 20 million plus TCV 3-year contract that we had. There were 3 contracts overall. This from banking was one of them. There were 2 that came from the travel vertical.
That you are doing differently because the macro environment has deteriorated seriously, but you are able to maintain the guidance. So is this largely because of a differentiated approach, different clients, you've added new differentiated products? What is different about Coforge?
I think at the core of it is the ability to execute, and the ability to execute that's been proven over the last 6.5 years. Our growth story is not a 1-year or a 2-year story. Our growth story is not a story where we're talking about doing new things which will land us to growth. We've always said what we've done in the past, the learnings from the past are what we need to extend into the future. What I believe we do well is that, like a lot of our peers, we also sign large deals, possibly with a greater velocity and an increasing median deal size. But equally importantly, and this is something that one needs to watch out for, our ability to retain the book of business that was with us from earlier quarters is exceptionally high. Our repeat client business, our repeat business from existing clients is 93%. That possibly is one of the highest levels for a firm our size. So what I suspect are doing differently is 2 things. One, our ability to sign large deals and to sign large deals at a gradually increasing median size level is significantly high and getting better. Second, equally importantly, our ability to make sure that the existing book of business does not see a drip going away is also exceptionally high. The two metrics that I've always differentiated Coforge is one, the repeat business from existing clients, and two, employee retention. For the last 6 years, Coforge has had consistently the lowest employee attrition of any IT services firm on the planet. For the most part, there might be a few exceptions. These two things on the execution template are what have set us apart, and I suspect are likely to continue to set us apart from the commentary that you hear and the performance that you see.
Well, Sudhir, good luck, and incredible the kind of resilience Coforge has reported. Let's take a break with the news that we've recovered from the day's low, not in the green for the benchmark indices yet, but the small cap index almost there. So again, it's the local crowd, HNI, DII, which are calling the shots. Yes, globally there is a worry, there is a concern, but frankly, if one looks at the setup is very simple. Two parallel markets, the local dominated parallel market by HNI investors and retail investors, that's doing good. And the FI dominated market, or institutional dominated market, which is falling because of the weight of weak global cues.